A trading strategy is a set of steps and rules that help you decide what stocks to buy or sell, when to perform these trades, and how much money to invest in them. Designing a successful trading strategy that reliably generates profits for you while minimizing the risk of losing money is indeed a complex task. Once you have found a signal that seems to indicate the future performance of a stock, it is time to put it to action. For instance, if you think that a stock has upward momentum, you might want to buy some shares and hold on to it for a fixed period of time or till you start seeing the stock fall. This is known as taking a long position on the stock. When you sell your stock, hopefully at a higher price than you bought it, that is known as closing your position. But what if the stock has a downward momentum and you believe that it is going to keep falling for some time? In this case, you can take what is known as a short position on the stock, selling first and then buying back later, hopefully at a lower price. If this is the first time you're hearing about shorting, it might sound bewildering, but what it boils down to is borrowing shares from someone, usually your broker, and then promising to return them once your short position is closed. The broker's incentive here is that they typically earn a commission on the profit you make from the short sale. At the same time, they are taking a risk. What if you bail out and never buy back the shares? For this reason, brokers typically require you to keep some money in a margin account that they can charge if you fail to keep your promise. The whole process of short selling is a bit more complex with interests, fees, and margin calls coming into the picture. But all you need to know when evaluating a potential trading signal is that shorting is one possible action you can take. So, when you think a stock is going up, you can buy or go long, and if you believe it is going to keep falling, you can short it. However, dealing with individual stocks can be tricky and unpredictable. You don't want to put all your eggs in one basket. Therefore, it is recommended to adopt a cross-sectional strategy where you invest in multiple stocks at the same time. One smart way to do this is to use your signal to rank order the stocks and use the rankings to select stocks for long and/or short positions. For instance, if you're using a momentum signal, the top performers are likely to keep rising, so you can go long on them, and the bottom performers that are falling are likely to keep falling, so you can short them. This has the added benefit that you're using the relative performance of stocks to compare them. Here's how you might approach the problem of formulating the complete trading strategy. Our goal is to construct a stock portfolio of long and short positions, and the selection process for stocks to go into the portfolio is based on the stock's returns performance relative to other stocks. For this example, we shall assume we are periodically reevaluating and rebalancing stock holdings every month end. Let's use the S&P stocks universe. The top 500 stocks trading in the US, tracked by the S&P 500 index. A stock universe is a general term in finance that refers to a group of stocks that share certain common features, belong to the same market, or simply a set of stocks that are used in verifying or simulating trading strategies. First, we fetch the daily close prices of each stock since mid-2013. Please note that it is important that we use adjusted closing prices for analysis purposes. Also note that the composition of stock universes changes over time. For example, around 10 to 40 companies leave or enter the S&P 500 every year. When you test your strategy, it is important that your dataset for 2013, for example, contain the companies that were part of the universe in 2013. In fact, your dataset for any point in time should contain the companies that were in the universe at that time. If you use the current composition, for example, the current S&P 500 index in 2017, then you will effectively be testing your strategy on the subset of stocks that survived to 2017. These stocks probably performed better than the ones that left the universe, so the performance of your strategy will look better than it should. This is a subtle error that analysts often make and is known as survivorship bias. Now, since we are only interested in month-end prices, we can resample the daily closing prices into monthly prices. Then we can form a log returns time series from the monthly prices. For each month-end observation period, we rank the stocks by their month-end returns from the highest to the lowest. select the top performing N stocks into our long portfolio and the bottom performing N stocks into our short portfolio. You could also choose a fraction of stocks, say the top and bottom 10%. To simplify this example, we'll assume every stock gets an equal dollar amount of investment. This makes it easier to compute the portfolio's monthly returns performance as the simple arithmetic average of the stock returns. Lastly, the combined portfolio's monthly returns is the difference between the long portfolio's return and that of the short portfolio. Now, continue doing this for each month and period, and you have a momentum-based trading strategy. Now we are ready to perform our analysis. The resulting returns time series is the theoretical monthly performance of our long-short portfolio. Our goal is to see if the mean monthly return is greater than 0. Let's calculate that. Okay, so our mean is indeed greater than 0 at 0.53%. But does this mean that we got this value because, on average, this trading strategy yields positive returns? That is to say that the true mean is greater than 0? It could be that on average, this trading strategy will not yield positive returns. Maybe the true mean is less than or equal to 0, and this value is just a random fluctuation. Well, one approach to assess this is to perform a statistical test on our hypothesis. A t-test is a way of testing the probability of getting as big a mean as we did, assuming all the assumptions we made to build our model of strategy returns were correct. In our case, we can compute the t-statistic by dividing the mean return x bar by the standard error of the mean SE x bar. Using this t-statistic, we can measure the probability of getting a mean monthly return of 0.53% or larger if the true mean monthly return is 0. Given that the assumptions we made to build our model are correct. This probability is called the p-value. If the probability is very small, we might infer that it's unlikely that the true mean is 0. Now, before running the test, we should decide how small the p-value needs to be for us to conclude that the true mean is not 0. To denote this threshold, we usually use the Greek symbol alpha. A commonly used value is 0.1. Setting alpha sets the false positive rate for the test. So, if we set alpha equals 0.1, we are effectively saying that if we use this threshold, we are okay in correctly rejecting the null hypothesis when the true mean is 0 in 10% of many hypothetical uses of this test. By performing a one-tailed t-test on the alternative hypothesis that the mean of these returns is statistically greater than 0, we calculate the p-value with a stats package using a degrees of freedom of n-1 equals 47, and we find that the t-statistic is about 1.618 with a p-value of 0.0566, meaning that the result is not significant at p less than 0.05 level, but is significant at p less than 0.1. This means that we are fairly unlikely to get a mean of 0.53% if the true mean is 0. This result shows some initial promise that there could be some alpha contained in the strategy, and thus serves as a quick sanity check to justify investigating further and fine-tuning the strategy, leading to a full backtesting exercise in the end. If we measure the monthly performance of the SPDR S&P 500 ETF SPY over the same period, we would find that the mean monthly return is 0.83%, which is actually greater than that of the strategy, at least at this preliminary stage. To be clear, comparing our momentum strategy to the strategy of investing directly in S&P 500 ETF is not really a fair comparison. These are two very different strategies. For one thing, ours involves taking long and short positions, while investing in the S&P only involves taking long positions. However, this gives us a vague idea of what values portfolio returns might take. Also, while our strategy is obviously simplistic to begin with, this shows that it is actually not an easy task to find a strategy that can outperform the market. Note that if you get a very large p-value at this early stage, you wouldn't want to go back and make meaningless changes to your strategy, like changing a parameter a little until you got a very low p-value. Doing this is called data snooping or p-hacking, and would just fine-tune your strategy to exploit the particular random fluctuations in the data set you have. A strategy devised that way would be unlikely to perform well on future data. What you should do instead is make meaningful changes to your strategy. In other words, you should come up with a different idea for a strategy and test that instead.